Over the past few years, the Japanese yen has slid in value against many major currencies. One of them is no other than the US dollar. If we were to graph out the official exchange rate of the yen to the US dollar, we get to see that the yen had slid in value dramatically. In 2019, prior to the COVID-19 pandemic, the Japanese yen was trading at 109 to a dollar. But in 2023, the yen had been devalued massively to over 140 yen to a dollar. Some months in the year 2024 also saw the yen trade at 160 to a dollar. This value wasn't seen for a very long time. If we were to extend the graph and include previous decades, we get to see that the yen hasn't been this undervalued since the 1980s. This, as many analysts have said, has been a significant contributor to the increase in Japan's exports and tourism sector. For instance, if we were to graph out the export growth year over year of Japan, we would see that the country's exports have been growing. In some months of 2024, Japan's exports had grown by more than 10%. This is partly because of the weak yen, which helped boost the competitiveness of Japanese products in international markets. A weaker yen, after all, helps make the cost of Japanese goods and services cheaper for foreign buyers, thereby increasing demand. On top of that, if we were to graph out the number of foreign tourists arriving in Japan, we get to see how much it increased for the year 2024. This is again a reflection of the weak yen, which has made Japan a much more affordable destination for international travelers. The combination of lower costs for accommodation, food, and shopping compared to other major tourist destinations has led to a surge in visitor numbers. But at the same time, the weak yen has also caused Japan's import costs to surge, particularly for essential goods like energy, food, and raw materials. This has led to imported inflation affecting both businesses and households. Since Japan relies heavily on imports for its energy needs, the depreciation of the yen has drastically increased the cost of fuel and electricity, placing a burden on consumers and industries alike. But the weak yen, which caused significant changes to the Japanese economy over the past few years, may finally change. The yen may finally go back to a stronger position. If we were to graph out the yen's exchange rate to the US dollar, we get to see that since the middle of 2024, the yen has been appreciating in value. You can see that, despite the yen trading still at high 140, it shows a trend of going back to a stronger value. Of course, a lot of reasons can still be made as to why it may stay in this value for a longer time. But there's an argument as to why the yen may actually appreciate in value. To understand why that is, we must first understand what caused the yen to depreciate in value to begin with. During the COVID-19 pandemic, many economies around the world had faced significant contraction. Japan is no outlier in this situation. The economy of Japan contracted by over 4.1%, which was the biggest contraction seen since the 2008 global financial crisis. The result of this contraction was combated by fiscal and monetary stimulus. Japan, the United States, the European region, and probably all other nations globally have launched fiscal stimulus. Fiscal stimulus, in case you're not aware of what that means, is basically the use of government spending and tax policies to stimulate economic growth. When a government implements fiscal stimulus, it increases spending on infrastructure, social programs, or direct cash support to households and businesses. Monetary stimulus, on the other hand, happens when the central bank, for instance, the Bank of Japan, has lowered the interest rates, printed money, or bought up government bonds of the country. This would also help push economic growth, as it encourages spending, borrowing, and investment. But as many of you know, the result of this was significant inflation. Inflation was seen. It was seen in the United States, Europe, and many countries around the world. Japan was no exception to this matter. If we were to graph out the inflation rate of Japan, we would see that Japan's inflation had increased substantially. This is a substantial increase because Japan didn't really see inflation at all in its country. In fact, it experienced deflation, which had been one of its defining economic challenges for decades. To combat the inflation, the governments globally had to take action through various monetary and fiscal policies. Central banks, including the Federal Reserve in the United States, the European Central Bank, and others, aggressively raised interest rates to slow down inflation. However, the Bank of Japan had taken quite a different approach. Instead of raising interest rates to combat inflation, the Bank of Japan had actually kept their interest rates low. This is because, for a long time, Japan didn't really see inflation. For them, this inflation rate was more of a new economic phenomenon rather than a recurring challenge. Unlike the United States and Europe, where inflation had been a persistent issue, Japan had spent decades grappling with deflation, a scenario where prices stagnate or even decline. Because of this, the Bank of Japan was hesitant to react aggressively to rising inflation, fearing that premature tightening of monetary policy could stifle economic growth. The result of this no change in interest rate, whilst many other economies globally had been hiking up interest rates, is the devaluation of the yen. This is because investors moved their money to countries with higher interest rates, like the US and Europe, where they could earn better returns. Since Japan kept its interest rates low, the yen became less attractive, causing it to lose value against major currencies like the US dollar and euro. That is, in simpler explanation, the cause for the yen's decline in value. But this same principle is what is going to cause Japan's yen to become stronger when they increase the country's interest rate. If we were to pull up the interest rate graph again, we would see that in the past few months, the Bank of Japan had actually been hiking up interest rates. In contrast, if we were to compare it to the Federal Reserve, they have been lowering interest rates. The shift in the two central banks means that the yen has a chance to regain its strength after years of depreciation. With the Bank of Japan raising interest rates and the US Federal Reserve lowering them, the interest rate gap between the two countries is narrowing. This makes the yen more attractive to investors, leading to an increase in its value. So, you can clearly see why the yen is going to become stronger, and it's all because of the change in interest rates. But to begin with, why is the Bank of Japan changing its stance after years of keeping interest rates low? The answer again, as we mentioned earlier, lies in inflation. If we were to check the data on the interest rate of Japan by month as of the latest months available, we get to see that Japan's inflation rate has reached a height where the Bank of Japan may need to increase interest rate. For instance, in January of 2025, the inflation rate of Japan had been over 4%. That's a very high figure. The Bank of Japan had long aimed for a 2% inflation target, believing that moderate inflation would help stimulate economic growth and avoid deflation. However, when inflation exceeded 4% in January 2025, it became clear that the BOJ could no longer delay action. If they were to leave the interest rate as it is, then inflation would continue to rise, putting more pressure on households and businesses. The weak yen would also persist, keeping imported goods expensive and making everyday necessities like food, fuel, and electronics costlier. In short, doing nothing would mean Japan remains trapped in an inflationary cycle where wages struggle to keep up with rising prices. And that is also another major reason why the Bank of Japan had to increase the interest rate. Not just to combat inflation, but because wage growth hasn't been keeping up. If we were to graph out the real earnings, including bonuses of Japan, we actually get to see that it isn't rising. It's mostly negative at most months, with only a number of months showing positive. This data basically shows that Japanese workers are losing purchasing power. Even if wages are increasing in nominal terms, inflation is rising faster, making real earnings decline. So, in the short term, we may likely see the yen trade at this level. But in the longer term, the yen would eventually get back to its original value. But this is again still a question rather than a confirmative scenario. The reason being is if Japan can actually continue to have this inflation trend. If inflation were to decrease again, and the Bank of Japan were to do a U-turn, and instead of increasing interest rates, they would decrease them, then it is possible that the yen's value could stay the same. But from the looks of it, the inflation rate which has been very high as of late, would likely help interest rates higher and thereby appreciate the value of the yen. But anyway, do let us know what you think. Thanks for watching.